So the big tax question is this: how do wealthy people keep their money working for them when selling their business, real estate, or other highly appreciated assets without paying hundreds of thousands to millions of dollars in tax? What if we, as business and real estate owners who have poured blood, sweat, and tears to growing our wealth, and who didn't hire expensive tax attorneys and CPAs to map out an exit strategy, knew their secrets? Instead of recreating the wheel, why can't we just model the way they deferred 30 to 50% in tax, paid off debt, funded their next business dream, and most importantly, leave a financial legacy to give to the causes we believe in most? What if their secrets weren't complicated at all, and you just need a guide who is a few steps ahead of you? That is the question, and this podcast will give you the answers. My name is Brett Swarts, and welcome to Capital Gains Tax Solutions. Welcome to the Build It to Billions podcast, where we guide successful entrepreneurs and investors on the journey from millions to billions. We believe the key to scaling and compounding your wealth in life starts every single day with the mindset and practice of stewardship over ownership and applying billionaire biblical principles. Each and every guest we have on the show is an entrepreneur, millionaire, or billionaire, and they share their insights and wisdom with us. I'm Brett Swarts, and I'm excited to be a host today and grateful for the opportunity to bring on our next guest. He's the founder and managing partner of Peak 15 Capital, a private equity firm specializing in equity and debt across various commercial real estate classes, with a keen focus on high alpha returns. Through deploying capital from in-house discretionary funds, Peak 15 Capital partners with developers, sponsors, and operators on entire asset types in geographical locations, and so much more. Please welcome to the show with me, Mr. John Azar. John, how are we doing?
Thanks, man. I appreciate it, Brett. Thanks for having me on the show.
Great.
It almost sounded like you could probably do a double for like that non-disclosure statements that usually ads have at the end of it. You can definitely do a double on one of those things. So.
I'm looking forward to that, man. I'm looking for another side hustle here. For our listeners, get to know you for the first time. Would you give us just a little more about your story and your current focus?
We're a private equity fund. We're based in Charlotte, North Carolina, but we're national coverage. We have offices in LA and New York, and we focus on providing liquidity to sponsors, operators, developers across a wide spectrum of commercial real estate asset types. We are asset type agnostic to large part. We have few assets that we are completely not touching, but for the most part, we are multifamily, industrial, self-storage, built to rent communities, built to sell communities, that type of focus. Our focus is really sort of the returns and the viability of the deal and the people behind the deal. And I want to emphasize the people part, because that's a huge part of our. That goes even above and beyond our underwriting, is the people have to be right in every single deal, not the deal itself. So.
Excellent. And today we're going to be talking with John about the 3 red flags that you want to be aware of when any kind of commercial real estate deal. Let's dive right into it, John. John, what's the number 1 red flag when it comes to investing into commercial real estate with a sponsor, operator, or a fund?
Well, these are things that you've got to watch out for sure. I mean, you have to it's the experience of the operator, of the sponsor. I mean, that is the very, very first thing that could either be a red flag or could be a green light. It just depends on how you're looking at it. But the experience is hugely important, and the experience is not necessarily in just how to execute that particular deal, but it's how to manage it and usher it, and as you said so aptly earlier, steward it into fruition and into a profitability at the end of it. And these are 2 separate things. Buying and acquiring a deal, because people mistake buying and acquiring a deal as the same thing as operating it and seeing it to its full fruition. That is not the same thing. A lot of people can buy deals, but not a lot of people can actually stick there and operate it and see it through until it's kind of the end cycle, which is, kind of cycles out of their portfolio. So you have to have that experience. That is the first red flag. If they have not done that type of deal in that type of market, that's our first red flag that we generally talk about. So the experience is huge. The experience can create, like I said, either a red flag or a green light.
Right. To that point, before you go to number 2, I can agree with you more. I mean, that's so key, because this marketplace has seen those who we call the Warren Buffett skinny dipping, right? The tide has come out, interest rates have jumped. Gosh, I mean, it's tough, and I have some compassion for them because we got caught on a couple things, smaller positions for some of our clients and passive deals. But you had I think the triple, kind of a triple whammy on both sides. Number one, you had low interest rates prior. You had double digit rent growth in a lot of markets. You also had cost seg bonus depreciation 100%, and that was like this fueling this multifamily just surge. And then all of a sudden, property taxes jump, property insurance jumps, interest rate goes through the roof, bonus depreciation goes 80, 60, 40, and so all of a sudden, boom, 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 like you lose all this momentum that was driving these things. And now people are losing it, right? I call it the year of the jujitsu tap out, multifamily. They've been in an arm bar for survive until 25, and they're holding that arm bar and they're about to get snapped. So what is your sense on the distress in multifamily right now?
Well, the distress is real, and it's finally coming to the surface. I mean, we are finally starting to see sort of the thesis of our fund that we initially built it for a couple of years ago is the distress, is the blood on the ground, which we were probably about a few months off from what we initially built it for. We thought that this blood was going to start happening last year, but the bloodletting has not happened last year. The bloodletting is actually starting to happen this year, and it's already commenced. It's not coming. It's already here.
Yep.
People are just not seeing it. It's just not mainstream. So unless you're in the business, you're not really seeing that blood on a day-to-day
Right.
basis. But
I agree.
we are seeing it when you're dealing with lenders, when you're dealing with brokers, when you're dealing with other institutional investors, when you're dealing with so many sponsors and developers as we do. You certainly starting to see and feel that blood that's on the ground right now. I mean, our last two deals that we've done in the fund have been distressed asset deals, and I think, and we expect that to continue forward.
Yeah. Okay. So I agree with you exactly on that, and I think it's tough. I think everyone's kind of getting hit unless you had longer term fixed rate debt, unless you're able to umbrella your insurance across thousands of units and get a decent, better rate, and to blend that in a fund model, and then property tax is just tough. But I mean, all three of them. If you don't have ways to shelter or extend, then values have just the DCRs and the lack of rent growth and the pullback and in a lot of these markets is just making it tough. And so I couldn't agree with you more. So I think that kind of goes to the first point of the experience part. Make sure that you have an operator that's operated in these distressed markets, in these down markets, because I guess it's also probably easy, John, to operate in a market that's going great and rents keep growing, right? And then now you got to operate in a different market that's tough. That's the first, big red flag. Do they have this type of operational experience in down markets? What would you say is the second red flag when it comes to commercial real estate? If you're going to be partnering or investing with somebody.
Well, the second red flag goes into what you just said earlier, actually, about what happened in the marketplace and why we're seeing the blood now. It's so a couple of years ago. I'm going to regress a little bit to go back to 2022, 23. What we were seeing in 2022, 23 were just faulty assumptions. Assumptions that it's not about just insurance, it's not just about taxes, but assumptions in general about rent growth in particular, and the viability of the debt that's in place. These two things alone probably killed most people that we're now seeing the blood on the ground for, because in 2022 you have almost a perfect storm of overvalues and over leverage, and these two things played together to create a Molotov cocktail effect now that are so the values are the overvalued that were fictitious to begin with are now coming down to more reality level, and the over leverage have caught up with with those operators who over leveraged their properties in 2021, 2022, 2023 at unsustainable rates. And then to the light that actually lit that Molotov cocktail is their faulty assumptions. The assumption that rent growth is going to continue to be 10, 15, 20% year after year. And we saw that, and we passed on so many deals in 2022 and 2023. In fact, we passed on so many deals. Even our own investors were like, "Dude, are you guys going to invest, or what's going on?" But it was a hard place for us to be. It was a very hard place for us to be because we had to sit out. We had to sit out on so many deals, and we weren't doing anything. We weren't doing any deals for a long time, but. But I would rather be in the boat that we are today. I'm very blessed and thankful that we did that back then, even though as painful as it was, because now we're seeing those deals come to fruition. So to your point, the second red flag are the assumptions. The assumptions that operators or sponsors or they're underwriting to their deals, that is hugely important. And
Okay.
obviously, the bad part that I feel bad for investors who are not educated well on that is that they see assumptions and are like, oh, great, you're gonna make 25% IRR on this deal. That's amazing. I'm in. Well, how do they get to that 25% IRR? How do they get to that 30% IRR? Well, how do they get to the 2.5x multiples? If you dig deeper into the underwriting, or if you dig deeper into the assumptions, even if you're an individual investor, you don't even have to look at the underwriting. Just ask them for assumptions. Ask them what their expected rent growth is that's getting them to those values. What are their expected expenses that they expect to have on this asset for the next 2 to 3 years? What are their expected loan coverage ratios, or the maintenance costs that they have? So all of these things, if they're not at a reasonable level, and a reasonable level is going to be very austere approach to those numbers. So for us, when we underwrite something, we don't add any growth in year one. Year one has no growth for us when we underwrite deals. Year two, a growth starts, and as far I'm talking about rent growth, growth starts in year two, and this is no matter what kind of asset you're buying. It doesn't have to be this is not just about multifamily. It could be multifamily, industrial, self storage, whatever kind of deal that you're buying. Any deal that you're buying that has rental income tied to it, which is 98% of commercial real estate deals. So if your growth assumptions are that I'm going to make 10% on year one, and then another 10% or another
Got it.
10% a year two, year three,
Yeah.
that is going to be way
Yeah,
too
so I
aggressive.
think a part of it is understanding baselines and patterns and reasonable, growth assumptions on expenses, whether they're deflated and also rents and such. And
Correct.
so, so that I think that's important. Okay, it makes sense on number two. So the assumptions. By the way, if you want to learn more about John Azar, you can go to peak15cap.com. That's peak15cap.com. Their strategic partnership in U.S. commercial real estate investments, and they invest directly alongside trusted local operators through strategic partnerships across a diverse U.S. commercial real estate spectrum. They have over 30 years of experience. They've raised over 100 million in capital, and they have term sheets of $1 billion plus. So you can check them out. Go to peak15cap.com. So what is the number three biggest mistake when it comes to investing, passively in commercial real estate deals?
From an investor standpoint, or from an operator standpoint?
Either or is fine. Yeah.
Well, I think probably underestimating timelines, or
Mm.
or not getting the timelines right. So if you're an
Mm-hmm.
investor and you think, yeah, I could probably stand to put an investment in something for 2 years and get my money out. Well, you
Mm-hmm.
got to be very careful on again, it goes back to the assumption, like is this investment really viable for 2 years as an exit strategy? And it's the same thing for operators and developers as well. Like, sometimes they say, well, yeah, we can get you, 1 to 3 years. So we tell our investors, yeah, we are average hold, I stress, is 3 to 5 years. That's average, but that's not necessarily. I have the ability to maintain my investment up to 8 years, as a fund mandate. So, if an investor coming to me who's, let's call an investor, 75 years old, person, post retirement, they're years into their retirement, they're in their mid to late 70s. This is I'm probably going to be very frank with them and tell them our investment is probably not going to be the right one for you, because I don't know when you're going to need liquidity. But if you're going to need it any less than 5 years, you should probably not invest in something like this. So,
Okay.
real
Good.
estate
That
is a
makes sense.
long-term game. It's not
Understanding
a short-term
timelines.
game.
Got it. What's the next? I know we just said three, but let's keep going here. What's the next? Big red flag. If you're a passive investor, you're looking at a commercial real estate opportunity that you want to be able to be careful of.
I mean, again, I think we've covered three, but I mean, added on to that, it would be not the experience, probably locations, the market. If they could do some market studies themselves, the investors themselves, into how the assumptions are happening, what are their market likes, and invest in markets that you like as an investor, as an individual investor, or maybe you have some understanding of. Like, if you're someone who lives in the Southeast, then invest in the Southeast. If you're someone who lives in New Jersey and you find a property that's in New Jersey that somebody's raising capital for, then that's probably a good investment for you, because you understand the market. You know that the assumptions, you can vet out the assumptions, because you probably know what the rents are in this area. You probably know what the sort of economic climate of that area is. So,
Okay.
essentially invest in things that you can bring some understanding from your life into.
I love it. Excellent. There's a couple other ones too that I think are worth mentioning. Yeah, aggressive underwriting. We kind of mentioned that if numbers only work in a perfect world scenario, they probably won't work at all. Weak market fundamentals. So like if you don't really understand the local where the property is, or the people that don't understand it, and they're not, I think, living there or operating there, or have a track record in that local market. They might be really good in a Denver market, but they're not great in Dallas, and they're thinking they're just going to complete their business plan with similar assumptions, but it can be very different.
That's right. That's
no
right.
skin in the game. Talk about that. No skin in the game. I think this is really important. If the sponsor isn't financially invested, they're not truly invested. How much skin in the game do you want to see for the sponsors? And what have you found there to be a good amount?
Skin in the game is an interesting topic because we give our sponsors that we invest with and in a big girth on their skin in the game. Skin in the game has to be meaningful to the sponsor themselves. So meaningful to someone could be 100,000. Meaningful to someone else could be 500,000. It depends what that is, but they have to keep that in the deal, not just cash it out of the deal on day one. Meaning that, if we look at a deal structure and we look at all the deal fees between acquisition and origination and everything else like that, if they're walking away with their money back at closing, that's probably not going to be a good scenario for us. We need them to keep their money in the game because we want them to have alignment with the investment, with us and with investors, that they're also encouraged to make the deal work and make the deal successful. There's no alignment if there's no skin off your back. There's no alignment. There's why would you care whether the deal does 10% IRR or 30% IRR? You could care less. You already got paid.
Right. Oh, that's so important, right? Yeah, you got to follow the capital, follow the money, and make sure that it's mutually equitable and aligned. If it's not, I've also heard the other side too, where if they don't have any upside for the like if it's such a high pref, and they're like, well, we don't make any money until you make your money, and there's some like, okay, that's some good things to that, but then there's also like, if the pref is so heavy in favor of the passive investor, and let's say 2 or 3 years goes by and they're like, this deal is breaking even or not making any money, it's never going to catch up. Like the sponsor could just be like, well, I have no incentive because I'm never going to get paid on this anyways. And it's this weird, it was too much in favor of the passive investor, if you will. And it wasn't equitable for the value and the time and the energy and the effort and the risk that the sponsor was bringing, and it can completely disincentivize them to stay in the game when they're so far behind this preferred return. So you want to talk about a little bit of that dynamic and what your thoughts are on that?
I mean, in terms of what, like the how we look at the numbers, or what do you mean?
Yeah. So like, I'll give you an example. Let's say there's like I'm going to throw kind of a higher number, a 12% pref, right? If you bring $1 million, and then it's like, if you bring $3 million, you get 15 prep or something, just, pretty high.
Yeah.
But it can even be an 8 or 9 or 10 or 7 or 6 or whatever, right? But if the deal is not producing, this pref is like a debt. It just keeps compounding in the favor of the passive investor. That's per the documents, right?
Sure. Yeah.
And if the sponsor is really never getting paid or getting paid very little until the pref is paid, until they perform, which makes sense too. But if it wasn't, and this is where it comes down to the market fundamentals in the deal itself, like, is it going to actually be a winner, right? Versus just a dog. And they get behind in a couple of years, and then they're like, well, what's the point? Like, I'm never going to catch up to this pref, and this passive investor is not doing anything over here. I'm doing all this work, and I could literally work for the next 3 to 5 years just to pay them back. If that makes sense?
Yeah.
So this dynamic of like, making it. I like the book by Mr. Sam Zell. Yes. Am I being too subtle? And he talks about making equitable partnerships, right? Equitable is a really important word. It's not fair. It's equitable, right? And so, fair is, is a word that gets thrown around.
Fair is a very etherical concept. So it's
Yeah.
not, yeah.
So equitable, and he actually gets really practical because I had a partner, and I think he started off at 80-20 or 70-30, and he had him work his way to 60-40 and prove himself, and then 50-50. But it wasn't like, we're just going 50-50. It was more like, no, you're gonna go perform and make this thing happen. Now, it's Sam Zell, and it's a different situation, but just the concept of that, I think I don't know what the answer is. That's what I'm kind of asking you, John. Like, because at first, when you hear that at first blush, you're like, yeah, that's great. I'm the investor. I get paid everything back until this, and they're not going to get paid until that. And it feels good, and it might attract some people. But if you let that color all of the other red flags that we've already talked about, you can be making a mistake. And you actually want to look for not only the experience, but a mutually equitable arrangement with the preferred return and the fees and those things. Is that making sense, John?
For sure. Yeah. First of all, let me back up and say, for those audience member who don't know what pref is, pref equity is, even though it says pref equity, it's technically debt to some extent. It's, for the most part, it's really treated like debt because it's for the most part, it's non-participating. In fact, that's the best part of pref. There are some pref out there that is participating, meaning that it will participate also on the upside when the time comes to sort of cash in those chips. We don't do participating. We try to avoid participating pref like the plague. We don't really try to do participating pref. And that's not to say that pref is all evil, because there are some pref works beautifully on some deals. If the deal is cash flowing, if the deal is actually viable, and again, it goes back to the viability of the deal, you have to make sure that the deal is viable enough that it's paying your pref. Because if it's not, then why bother? Then you're going to be in that boat that you just described a little bit ago. Nobody's making money except the pref provider. That's it. The only people that are making money are the pref guys. You're not making money as the sponsor. Your investors are not going to make any money. So until there's some kind of liquidity event, and even then, it's a big if your property is not performing well.
Right.
So you have to be very, very careful. It goes back to the underwriting. You got to underwrite well. You got to underwrite to where you're able to not only meet your pref obligations on a current basis, meaning currently, because most pref is divided by current and deferred. Current meaning that you have to pay that rate, on an annualized, on a month to month basis, almost like taking out a credit card. And then there's a deferred portion of the pref, and it's usually 50-50 or something to that extent. Usually it's like, if it's 15% or 14% pref, they usually charge 7 or 8% current and about another 7 or 8% on the back end. So if you are in that boat and you're taking on one of those pref partners, and again, nothing wrong with taking on pref, you just have to be the right deal. You just have to make sure that you are paying that 7 or 8%, if not more, on an annual basis, so you don't get hit by the end of your cycle with a gigantic bill that it's going to leave you penniless, and it's going to leave your investors penniless.
You got our second with John Azar, everybody. You can find him on LinkedIn too, just Azar, John Azar, or you can go to his website. It's just peak15cap.com, peak15cap.com. Let's move a little bit into, I call it unlock capital versus raise capital. I think also part of the year that Jiu-Jitsu tap out is there's investors are tired. They've either lost some money or they're just been dragged on capital calls. They have the returns haven't been to what they thought it would be, especially in multifamily. I think industrial's held up pretty good. Mobile home park maybe somewhere in between, but multifamily's kind of really been kind of it's just tough because they had such a good run. And so the operator, the fund manager, folks like yourself, John, they're looking to raise capital, and so they bring the deal and they're like, here's the business model, here's the plan, and the investors are kind of tired, right? And so I think the biggest challenge for those is the fact that they're not unlocking the capital. And what I mean by that is solving a problem and adding value before the money shows up. Mm-hmm. So here's an example. So we focus like a laser on capital gains tax solutions. We build capital gains tax exit plans that allows the fund manager and the operator to help their investor base exit deferred cap gains tax on Bitcoin, business, real estate without a 1031 exchange that seamlessly goes into the fund, which, as you know, a fund can't accept 1031 money, right? Yeah. So this becomes a bridge to unlock the capital because they have this thing to sell. But the problem is this 20 to 50% of the proceeds are going to be crushed by cap gains tax, depreciation, recapture. So I'll give you a couple of live deals that we just did. We just did a $5.5 million deal out of Southern California. They would have paid about 40% in tax. A business sale, and they're going into real estate. We've already done it, tax deferred. Did it with an automotive sale for like a out in Massachusetts, $8 million sale, deferred about $2.5 million in tax, went in mostly into real estate. Pretty awesome. Did it with first to do with Bitcoin, right? And so it's kind of like a 1031 into your fund with any asset of any kind. No timing restrictions, but none of the complications. And so we say unlock it through cap gains tax to bridge into your fund. And so I don't know, John, we just met in the last 30 minutes. A, have you ever heard of even a way to do that? And B, if what I'm saying is true, how does that help you in the future?
Well, I just want to clarify one thing. We're not the operator because you mentioned we're the operator. We're typically not the operator most of the occasion. There's usually an operator on the ground that we invest in and with. That's what our fund does.
But you bring in the capital. But you bring in the capital to the deal. Yeah.
That's correct. We bring the liquidity in the capital, but there's another operator on the ground that's operating
I'm with you.
for us on the ground.
Yeah.
So, but yeah, to answer your question. I mean, we cannot take 1031 necessarily into our fund, but we have so many different avenues of offsetting, whether it's tax strategies. We work with a lot of 1031 exchange providers that can structure a different way for investors who they have a 1031 to come into the fund because they could formulate an LLC separate, an SPV that's separate outside of that. Then they would 1031 into that SPV. That SPV would obviously have to have some kind of a tick or something like that. So it could be done outside of a fund structure, but it's a bit complicated, and you have to make sure it's worth it. Like for us, for instance, I don't know if we would go through the trouble of setting something like that up under $1 million. If somebody's coming in under anything under $1 million, it's just not worth it for us to set something like that up. But anything $1 million and above, then sure, we could look into strategies.
Yeah,
like
and
that
to that point,
it's
Bitcoin is not 1031 eligible for what John's talking about. A business sale is not eligible for what John's talking about. He's only in a primary home is not eligible, right? What you're referring publicly traded stock is not eligible. Private jets, artwork, collectibles, none of that's eligible for what John's talking about. John is referring to investment real estate. Potentially, you could do a drop and swap and do it, and then do a 1031 into maybe to an SPV, and that SPV can go into the fund. I haven't heard it put that way. And by the way, I'd wonder how many you executed on that because you're right. That sounds like a lot of gymnastics there. But our strategy is just to kind of close the loop. It's so simple. It's an installment sale with the trust, John. They sell it to a trust. They get a promissory note. We're in a completely different tax code than 1031.
That's awesome. That's
kind of like an IRA, kind of like a 401k, which can go right into the fund, right into the syndication, no problem. Just like any other investor would. So it doesn't affect your guys' entire ecosystem, right?
Yeah.
No timing restrictions, no like-kind replacement requirement, right? And so we call it. Yeah, we've put tens of millions of dollars with real estate operators and fund managers and syndicators.
That's awesome. That's awesome. I love it. Go see Brett and then come invest with us.
You got it. People want to learn more about this, go to capitalgainstaxsolutions.com. You can also check out the book we have with Kevin Harrington from Shark Tank and a couple others called Building a Capital Gains Tax Exit Plan. And it's basically the proven playbook for unlocking your ideal wealth plan when exiting and selling any asset of any kind. Doesn't need to be $1 million net proceeds, $1 million gain. Kind of makes sense because these more complex things, they're not really worth the trouble unless it's big enough. So make sure you go to capitalgainstaxsolutions.com to apply for a no-cost consultation call. All right, that being said, John, are you ready for the lightning round?
Let's do it.
All right, knowing what you know now, if you go back to your 25-year-old self, what's the one golden nugget to make sure you tell yourself to do?
Oh, man. Start investing in real estate, even at 25.
Nice. Number one book.
Never sell.
Got it. Number one book you read the last year.
And the last year, Against the Gods. It's a story of history of risk.
Excellent. How do you best stay ultra healthy and super disciplined?
Just get out. Just go outside. I'm a huge outdoor enthusiast, so anything outdoorsy is great. I hike. I try to mountain bike as much as possible. Run outside. So I try to stay outdoors as much as possible.
Nice. What are you most curious about right now?
What I'm most curious about right now is how much blood is actually gonna come through this market, and how well we're gonna be positioned to take advantage of that.
Yeah, I like it. Number one leadership quote that you strive to live by.
Uh, I always, always be open to learning because that's the best leaders are learners, not teachers.
Excellent. Number one way you're using ChatGPT.
The number one way to use ChatGPT, we
Yeah,
use
that
it
you're using
in,
it. Yeah, that you're
yeah,
using it.
we use it in our marketing. We use it in
Mhm.
mostly our marketing. A lot of our marketing is cut down in substantially. I'd say by 75% of the time using ChatGPT.
Perfect. The very last question is kind of the essence of the entire show. How do you best keep a stewardship mindset over ownership?
Think of it as your money. Think of everything you do as your money. And think of it as yourself. If you think of everything as your money and make those decisions based as if it's your money, then you will always keep that stewardess mindset.
John Azar, I want to thank you on the show. Thank you for dropping tons of wisdom. Thank you for giving us the top mistakes people make when investing in commercial real estate and the red flags to look out for. And thank you for helping people to create and preserve more wealth in the commercial real estate industry. For our listeners who want to get in touch with you, one last time, what is the best place for them to find you?
They can find us on our website, peak15cap.com. They can find me on LinkedIn, John Azar or Jalal John Azar, or they can find me on Instagram.
Amazing. Thank you, John. Also want to thank all of our listeners for listening to another episode of the Build to Billions podcast. We're also streaming on Capital Gains Tax Solutions podcast and YouTube channels. And we're on this journey with you to scale from millions to billions so we can give more all of it away to help MVPs, the most vulnerable people. My name is Brett Swarts, and I appreciate you listening or watching today. Please share this with someone who can inspire and help today as well. Go to capitalgainstaxsolutions.com if you have a massive exit going on. So you can build a capital gains tax exit plan to defer that tax and invest in groups like John Azar's Peak 15 Cap. Just go to capitalgainstaxsolutions.com to get started, and we will talk to everyone again real soon. Bye now.
You have just listened to another information-packed episode of Capital Gains Tax Solutions with Brett Swarts. We hope you enjoyed today's show and found it helpful. Visit capitalgainstaxsolutions.com to access the show notes and to access more resources. Don't forget to leave a review and join us again next time.